Well, hi there. Welcome to Chart This with Dave Keller. It's Wednesday, June 4th. Happy hump day. We made it over halfway through the week. Thanks for joining me here on the show. My name is Dave Keller. I'm the founder of Market Misbehavior, the president and chief strategist of Sierra Alpha Research, coming to you from an overcast Redmond, Washington, where I am happy to announce two things. Number one, it turns out they're roosters, not hens. That shows you how little we know about fowl. If you tuned into the show yesterday, I shared the latest development in the Keller family. We live out in the woods east of Seattle, about an hour, and we've got plenty of space and forest all around us. And we somehow gained a couple roosters, it turns out. We found a local expert, one of our neighbors, friend of a friend, who came over and said, "Yep, those are roosters." And it turns out they probably came in from the trail behind us. Who knows whose they are? I did get them out of the yard, though. That was an adventure for another day that I will share with you, maybe in a webcast or something like that. But for now, we are down two roosters, so that's good news. Speaking of that, I don't know how I transition into the current market environment, so I'll just abruptly do so. The S&P finished at the lows of the day, ended up being essentially an unchanged day. The S&P less than a point away from Tuesday's close. Bounced up to around 59.90, but at the end of the day, this was sort of a stalled out move after yesterday accelerating higher. Today, sort of wait and see mode. Interesting day, right? You had jobs data that came out weaker than expected. I think the big move by my read is in the bond markets, where you see bonds moving up pretty aggressively, rates coming down pretty quickly, both the TLT and the 10-year yield breaking trend lines, I would say, this week. And the S&P for now stalling out after this week's breakout. After Monday and Tuesday, pretty strong days. Today, more of a stalled out day. With that in mind, let's look at the markets. 3 steps to our market recap show. If you've not tuned in before, we'll look at the market review, market recap, and just focus on some of the key movements today. We'll look at the heat map and focus on names and themes and groups within the equity space. I have some charts hand selected from my own work looking at the markets today and breaking things down. And then we'll take a couple questions. We are live streaming on Facebook, LinkedIn, YouTube, and X. Wherever you're watching the live stream, you can put questions in as we go. Just find the comments section on one of those platforms. I can see those live as we go through the charts. And at the end, we'll take a question or two. Anything we don't get to, we'll put in the Chart This mailbag, which we will hit on Friday's episode. As I mentioned, S&P basically flat for the day, and you can see, out of the open, we accelerated pretty quickly up to just below 59.90. We came back around 10 a.m. Eastern to test yesterday's close, and I don't think that's a surprise, right? When people suggest that the market movements are random, days like today, I don't know how you could, in an intellectually honest way, say that based on what we saw today, because then for the whole rest of the day, we basically ping-ponged between the opening 30-minute high and yesterday's close, the opening 30 minutes low. There's a whole approach called the opening range. I don't talk about it much because I'm not a day trader, but if I was, the opening range, that first 30 minutes often becomes super meaningful. And I used to work with someone who would swear by the opening range technique, looking at the first 30 minutes, looking at the high-low range, and then using that as a framework to think about the rest of the day. I would think he's no longer with us, unfortunately, but if he was, I'm sure he would have loved a day like today where we just kind of respect to those levels. They become pivot points and we continue to watch them. So in the afternoon, we went right back up to the intraday high. We failed. We came right back to the previous support and yesterday's close, and that's where the market ended, just above 59.70. The NASDAQ was slightly higher, about 0.33%. The Dow slightly lower, about 0.25% lower. This ended up being an unch day, unchanged generally. Mid caps and small caps down a bit, but not bad, less than 0.25% or so. You can see the VIX drifting slightly lower, but this is like 8 cents for the VIX. So still kind of in a low volatility environment, remaining below 20, which is sort of our threshold of low volatility to high volatility for now. Sort of a wait and see kind of mode. Now, the big movement was not in the equity markets today. It was in the fixed income markets. While the equity markets kind of remained range bound and ended up finishing not far away from where we closed yesterday, bonds moved pretty significantly. Bond prices rallied pretty quickly after today's jobs number that came out before the open. Gapped higher and then just pushed higher, really made its high around lunchtime, Eastern time, and then drifted slightly lower into the close around just after 3 p.m. But The TLT finished up 1.6%. The yield curve generally moved lower today from sort of medium to longer term, longer duration bonds. So the 5, 10-year, and 30-year points all lower. The 10-year yield finished around 4.37%. The long bond yield just below 4.9%. The 5-year point got down to around 3.9% before rallying a little bit going into the close. What's interesting about this is if you think about it, bond and stock, the relationship between the stock market and the bond market is pretty fluid. As much as we think that it is very closely related, the correlations actually change quite a bit. And shout out to the team at Ninja Trader. I was talking with Jim Cagnina and others earlier today. Did their one of their market discussion shows earlier today. And was asked a number of ways about bond futures. We talked about bond futures, talked about interest rates and that relationship. And Jim's point, which I think was spot on, was the fact that those relationships are not static, right? Those intermarket relationships, as much as we want them to be, they're actually pretty fluid. And we're in an environment right now where I would say bonds rallying here, probably not great, because what that would imply is investors going away from risk assets and into the relative safety of U.S. Treasury bonds. Also means yields are going lower, which implies a lack of optimism for economic growth. I think the bull case from here for stocks would be kind of the opposite, right? You want optimism for economic growth. You want bond prices to go down. You want yields to go up, which eventually could be an issue. But I think there's room for them to go higher. And still just sort of represent the fact that investors are optimistic about the economy. Not the vibe I got today with bonds rallying after the jobs report this morning. The dollar index slightly lower, about a 4.4% to the downside. The dollar has been a pretty consistent downtrend in 2025, kind of continuing that trend here today. Commodities were pretty mixed, to be honest with you. The GLD actually ended up being up for the day. Had a pretty nice move earlier today, kind of in the morning, and then from there sort of stabilized and chopped around along with equities. But the GLD finished up about 0.2%. Silver was down about 0.3%. Copper prices slightly higher. Crude oil prices slightly lower. Kind of a mixed day overall. So again, the big movements were in the fixed income space. Cryptocurrencies kind of still stalled out after attempting to break to new all-time highs above 110,000 for Bitcoin. Bitcoin's currently just below 105,000, actually broke below there earlier today during the equity trading session. Yesterday, we were up around 106 to 107. So we're sort of giving back some of those recent gains with that run up to achieve a new all-time high over the last month. You can see most of the top 10 coins tracked on the stock charts platform in the red today. All right, shall we look at the sectors? Mixed, right? And I think that theme of sort of indecision, mixed, unchanged, that's sort of a constant vibe you're going to get when you look at the equity space here. There were things that were up plenty. There were things that were down plenty. We've grabbed some of those charts to share with you a little later. We'll see that on the heat map for sure. But in terms of sector breadth, looking at sectors up or down, you can see 6 of the 11 S&P sectors finished up, 5 of the 11 sectors finished down. Pretty much split 50-50. Top performers were communications services, up 0.2%. Materials up 0.4%. REITs up 0.3%. So kind of a mix of growth and value and defense, to be honest. On the downside, you have energy, which has mounted a pretty decent week up until today, down about 2%. Crude oil prices coming back after attempting to break out this week. So the XLE down about 2%. Utilities, which is one of the more defensive sectors, down 1.8%. Consumer staples, another defensive sector, down 0.7%. Let's see, where else can we look here? Breadth was not great, right? So even though the benchmarks were essentially flat for the day, the breadth, honestly, it depends on where you looked. If you look at the S&P 500, kind of a 2-to-1 ratio, 60% down, 39% up. If you look at the New York Composite Index, almost 50-50 split. Same for the NASDAQ, pretty even. You can see, again, color-coded neutral here. The breadth in the mid-cap index was the worst. The breadth in the S&P, large cap, mid-cap, small cap, not great. The New York Stock Exchange, for some reason, that's a bit of a head scratcher, but probably has something to do with what's on the New York Stock Exchange and what's on the NASDAQ, I guess. That's kind of a weird one, but for what it's worth, those are how the numbers played out today. So breadth kind of neutral to slightly negative today. It's worth noting that, I mean, even with all of this unchanged, On Semiconductor was up 6%. That's your top gainer in the S&P 500. So there were certainly things that were up. And also, I would say another thing, not to jump the gun too much, but you can see a bunch of home builders here in the top 10 list for the S&P 500. D.R. Horton, Lennar, Pulte Homes, all in the top 10 list, all up over 3% today. Rates coming down like that is a pretty good tailwind for home builders. All right, looking at the Magnificent Seven and Friends, these leading growth names, and again, can't stress enough the importance of watching mega cap tech and communications names. These are dominant names because of their market cap, because of their size, dominant in sector ETFs like the XLY and the XLK, certainly dominant in the NASDAQ 100 and in the S&P 500. So Meta continuing its breakout move up over 3% today. Netflix, which has arguably been the best of this basket of stocks, up another 1.8% today. Broadcom continuing to the upside, up about 1.7%. On the downside, Tesla, kind of the downside outlier, down over 3.5% today. Apple slightly lower, less than a quarter of a percent. Kind of a random one, but as I'm looking at the chart of Apple, I saw the news that Bob Pisani stepping away after 35 years on the floor of the New York Stock Exchange. What an incredible legacy there. Bob was one of the last of like the original CNBC hires when they launched that network, and based in New York. And I had a chance to meet Bob on visits to the New York Stock Exchange. What an entertaining, media presence, right? I think so many of us will think of, when you think of the New York Stock Exchange, you think of Art Cashin, think of Bob Pisani and others. Sad to see him leave, but I'm told he will continue to be visible in other areas of CNBC. So I think that's a good thing for all of us. All right, there's our market recap. Let's continue looking at the heat map. This is the market carpet on stock charts. Huge fan of heat maps like this. And I've spent a lot of my career working for really technology companies like Bloomberg and Stock Charts and others. And at Fidelity, spent a lot of time looking at digital signage and how to, summarize market activity using heat maps and other really cool visualizations. Something like this that allows you to look broad and more specific is so helpful. If you spend all of your time looking at charts, looking at individual stocks and what they're doing, it is really easy to get caught up in the minutia of day-to-day movements and of individual stocks, and you miss the trees, right? You don't want to focus so much on the veins on an individual leaf that you forget to think about the branch and the tree and the forest, right? I mean, think about the overall sort of broader themes. And so a heat map like this is a great way of sort of connecting the individual stocks that you see moving, like Tesla down, Meta up, but then thinking about the context, right? What's the overall condition here? So would encourage you to explore visualizations like this. If they haven't been a part of your process, I think they should. So what are the takeaways here? I'm actually drawn immediately to the reddish shade that you see in energy and that you see in utilities, right? So besides like the big ones like Tesla down, Palantir down, CrowdStrike, these are some large cap kind of tech and consumer names, although Tesla, you probably still call it a technology company that happens to make cars. But over here, you see the concentration of red in the energy sector. And that's a bit different, right? Because energy has actually had a pretty good week over the last couple of weeks. You started to see this move higher, right? I think investors starting to believe with crude oil prices pushing up a little bit, with energy stocks starting to improve a little bit. My podcast interview with Jesse Felder, we talked about oil producers, the XOP, looking at some monthly charts for that, but overall thinking of potential upside. Today, you're seeing those energy names, many of which have had some pretty good bounces here, starting to pull back a little bit. So I think still more to prove on the energy sector. The relative performance has been so underwhelming for so long. So I'm not quite a believer yet, but certainly an area to focus on. Utilities also down today. Now it's things like CEG, which had the announcement with Meta yesterday, finished lower a bit, and today kind of following through down another 4+%. But it's not just that. I mean, generally, you can see utilities were down. And I think that's important because if the market is going to stall out, if we're not going to get this upside move, if upside is limited and investors start to believe that fact, you would expect utilities, consumer staples, REITs to start to look a lot better, because that would represent investors getting to more defensive positioning. We're not really seeing that rotation at this particular time. Elsewhere, you can see it was actually quite mixed, right? Within consumer discretionary, things up, like the home builders, as we mentioned, a number of things down. Tesla as the most notable example of that, but GM and other automakers rotating to the downside. Within technology, I highlighted some of the names. And CrowdStrike made a new 52-week high yesterday. So let's keep this in proper context. This is a volatile name coming off of a new high, but still not great that it's coming down. Palantir as well, breaking out earlier this week, pulling back a little bit. So those trends are still fine, right? I mean, I think those are still in primary uptrends. We're still making higher highs and higher lows, but those are the ones you kind of keep an eye on to see if there's enough of a pullback to get you a little more nervous. Final observation I would make: look at what a mess communication services was today. All right, you have Meta up 3+%. You have AT&T down over 2%. Bit of a theme there with the three largest names, which are really more of the internet-y part of communication services up. The old telecom names like AT&T, Verizon, mobile names like T-Mobile were all down today. So it was a little bit more of a, kind of growth communications over value communications, but certainly an area of that market. That's why, honestly, if you look at the performance of the XLC, it's been flat all year. And what happens, I mean, my general summary of that sector is, before, when you had the old telecom sector, it was a very defensive sector, right? AT&T and Verizon were the two biggest names. Then it was like a bunch of, cell phone, like tower companies, et cetera, kind of getting down into the smaller ones. But now the newer communication services sector, it's been years now since that was announced, but it combined old school telecoms, media entertainment companies like Disney, Live Nation, video game companies like EA are in there. Internet companies like Alphabet, Netflix, streaming company. It was sort of this mishmash of things now. And the problem is, it's not clearly offense or defense. There are parts that are very offense oriented. There are parts that are very defensive as well. And so as a sector, it's actually not been a very good bet, because one part of that is working and the other one's not, or vice versa. So when Meta and Alphabet have been working, AT&T and Verizon seem not to. When AT&T looks like a really brilliant chart with a great dividend, Meta and others are kind of struggling. And so it's sort of hit or miss right now. And then the other thing I would say was financials. I grabbed a chart of the XLF just to show you, and Berkshire is a big weight, and it's actually testing a new 3-month low this week, which is something to focus on. All right, we'll get to the charts and start looking here. I do want to let you know the latest episode of the Market Misbehavior podcast released just about less than an hour ago. Actually, I just finally got that one out. Jessica Inskip. Jessica is the director. Oh boy, what is her title? I should know that. Director of Investment Research. Sorry, Jessica, at stockbrokers.com. Fantastic. She spent a lot of her career working with retail investors. Asked her some questions about what individual investors get wrong, what looking at second level thinking about interest rates and levels. It's really good, just kind of great conversation, touching on a lot of different topics. So I hope you can enjoy that one. That's on our YouTube channel. Also, last week's interviews with Tom Boley, who's a longtime Stock Charts contributor. Also, episode with Chris Verone was before that one. Those were 3 really good episodes. I think great conversations that I enjoyed a great deal, and I hope you enjoy them as well. Always interested if there are others that I could sit down with as part of the Market Misbehavior podcast. It's really a format where I can sit down with pretty much anyone and talk about the markets, ask them questions, and learn more about their process. So if you have suggestions, certainly let me know. One that came to mind, by the way, someone focusing on commitment of traders. And I heard someone earlier that I jotted down. So if you have others that you think would be good to talk about futures and commitment of traders and other things, let me know in the comments section. All right, let's see. Looking at the daily chart of the S&P 500, higher highs, higher lows. We have made a higher high this week for the move off of the April low. I think the general trend in this market, probably call this a bull flag pattern, to be honest with you, which is this move higher. We then have this pullback. I mean, it's very much a consolidation phase between 5,800 and 5,950 or so. Yesterday, we moved above there. Today, the question was, do we get follow through? It felt earlier, right around 10 a.m. I'm thinking, boy, this is a great follow through day. This is lights out bullish. But by the close, we went right back to yesterday's close. So it wasn't much of a follow through day. I would say still an open question to see if we can continue and push above those swing highs. But again, I'm thinking of this market as innocent until proven guilty. What's interesting is at this particular moment, we've made new highs on weaker momentum. That's not great. So if we would pull back from here, that is a classic bearish momentum divergence. It's still too early to tell because we'll see what happens through the remainder of this week. But I think it's something to pay attention to. I'm thinking of what charts to watch here besides just looking at the S&P and looking at key levels. Obviously, we can analyze these markets with a lot of different tools. I wanted to grab 3 charts that I'm looking for, sort of those red flag charts that when they start to turn, you really want to start to get concerned. None of these have registered a sort of bearish signal yet, but these are 3 that I would be watching for. Number 1 would be the bullish percent index in the NASDAQ 100. This is a breadth indicator that's not followed as widely as others that you may hear about on other platforms. This is a breadth indicator based on point and figure charts. But here's why. This is looking at the 100 members of the NASDAQ 100. So these are all large cap, mega cap technology communication names. Overall, the fact that we're at 75% means 3 out of every 4 members of the NASDAQ 100 have most recently generated a buy signal on their point and figure charts. If this would start to break below 70%, that would be a very bearish sign, because what that would mean is those leading growth names are no longer in uptrends. They're actually registering downtrends according to their point and figure chart. If that would happen, I would say the likelihood of the S&P and the NASDAQ being able to move significantly higher is minimal. And I would say the chances of the market retracing significantly very high. So I think this is an important chart to watch. For now, it's saying most of these stocks are in pretty good trends. Kind of look back here like February of 2024. That happened before sort of a major pullback into an April low. We eventually made new highs, so it's not an end of the world kind of indicator, but definitely would suggest that this uptrend we've had off the April lows is probably over. Not signaling yet. That's something I would watch. Second thing is with volume. I mean, if you look at the volume this week, it's not been great, right? We're sort of trending lower, I would say, over the last couple of weeks, volume-wise. I mean, the bull case from here, I think, would feel a lot more comfortable if we broke out on heavier volume. But I would say that things like the Chaikin money flow, which are really looking at trends in volume, are still pretty constructive. So what this is basically telling you is it's looking over a period of time and looking at the volume on each day, but weighted as to where we're at relative to the close. So if days are closing near the highs of the day, that volume is pretty positive. If we close near the lows of the day, that volume is pretty negative. We're looking at that over a window of time to sort of gauge accumulation versus distribution. And overall, it's been in a clear period of accumulation since the end of April. And I think as long as that maintains that green shading above the 0 line, that tells you that overall, even if we get some noise, there's still accumulation happening there. You want to get concerned when we flip below the 0 line. So that's something to look for. Not happening yet. Final thing would be a spike in volatility. That was a warning sign that we saw a couple weeks ago when the VIX popped above 20 after pulling back below it earlier in the month of May. We're down below 18 again. I think VIX pops higher. It's not a good thing. Markets probably, I mean, it could rally on higher volatility. That's very unusual. Most likely a spike in the VIX means investors are getting nervous and they're starting to, at this point, it's almost like, what's the word I'm looking for? I'm looking for an adjective. I'm blanking. Sort of agnostic, right? We're sort of volatility agnostic, sort of like it's a meh market. But I think the VIX pops above 20. That would be a investor starting to get concerned type of move. Let's talk about the bond markets, because the bond markets moved pretty aggressively. Right, the jobs data coming out lower than expected. The fixed income markets are telling you that's a problem. Are telling you, I think the fact that bonds are rallying or rates are coming down after that news tells you not as optimistic about the strength of the U.S. economy, right? So at this point, that sort of number suggests less optimism. As a result, bonds starting to rally, and even though stocks started strong, they actually finished more of the lows, and the TLT pushed higher. Rates is what we'll look at next. You can see rates are coming down, but I think looking at the chart of the TLT, and if you look at the bond futures, you get a very similar trend line. You can draw a trend line off the April peak, the late April peak. That lines up pretty well with some subsequent levels. And we've now, over the last week, broken out. The momentum is still not super strong yet, but I mean, I think the trend is starting to improve. And the PPO, which is a trend following technique, has now generated a buy signal, the first buy signal we had since the third week in April, which granted didn't go a lot higher, but certainly indicated that we were in a valid upswing. Now, the opposite you see on the chart of the 10-year yield, we're connecting the April low, the early May low, and that was actually broken here today. So we're right at the 50-day moving average, but we've broken trendline support. The PPO is giving a bearish sign, and that's what tends to happen when rates have come up and they're starting to pull back a little bit. So the charts are telling me bonds rallying, rates coming down here, and I don't think that's great for stocks given where we're at here in the cycle. Looking at some individual names, Meta, great chart. I mean, it's a great chart, right? And I think we're making higher highs and higher lows. We gapped above the 200-day. We kept going up. We had this gap around 620. That gap held. We've now broken above 660. This is a bullish chart. Think what you want about markets being overextended or overvalued. Meta's a good chart. And I'll tell you when it's not a good chart by my read, but it's going up and higher highs and higher lows are bullish. Tesla is not a bad chart yet, but it's starting to look a little less like a great chart. I can't help but notice this bearish momentum divergence. I think this is the risk for the S&P and the NASDAQ here, is this new high we're seeing this week is marked by weaker momentum. And Tesla did that about a week ago. He made new highs on weaker momentum, and now we're starting to pull back a little bit. Tesla's starting to look a little bit more vulnerable. I think as long as it holds the 200-day, this sort of major uptrend is still okay, but I'm seeing that get closer and closer. The financial sector, the XLF, not impressing here, particularly on a relative basis over the last couple months. This is a weekly chart of the financial sector ETF, the XLF. So it's looking back at the last 5 years, so a little longer term. This top panel shows you the relative performance of the XLF versus the SPY. You can see over the last month or two, the relative strength has really started to take a hit. And although we're holding up okay on a price basis, we're underwhelming on a relative basis. And one of the reasons why that's happening is names like Berkshire Hathaway, right? Berkshire Hathaway gapped lower earlier in May. Obviously, we've had the Warren Buffett news, et cetera. But from that moment, the stock has really started to accelerate to the downside. We did not hold the 50-day moving average on a pullback. We actually broke below it. The 200-day moving average is getting closer and closer. Berkshire Hathaway has not been below its 200-day moving average in a number of years. So this would be pretty meaningful if it's done that. Now, I own Berkshire Hathaway. I've owned it for a long time. I still own it in a retirement account. I'm not planning on getting rid of that. That's a long-term holding, in my opinion. But at this point, from a technical perspective, certainly looking pretty vulnerable. Now, the last couple times we've tested the 200-day, it's ended up being a really good time to buy. Let's see if that actually holds. I think that's crucial that we hold the 200-day. Otherwise, Berkshire looking like a pretty ugly pullback here. All right, let's take a couple questions. I see some questions, and yeah, Richard, you had a great question. Someone else in the YouTube comments, Bull Bear Jeff, I appreciate your answer. I don't disagree with your answer at all. Richard, you asked, can you offer what the difference is between the NASDAQ Composite and the NASDAQ 100? A lot of times people generalize and just say the NASDAQ, and I found they could be referring to either one. On a platform like Stock Charts, these are two different indexes, right? So the NASDAQ 100 is $NDX, and that's the ticker most platforms use. The QQQ is an ETF, obviously a very popular ETF based on this index. It's 100 of the largest names listed on the NASDAQ. So Meta, Amazon, Microsoft, Apple, Alphabet kind of stocks. They're all huge market cap names. It is a cap-weighted index, which means the biggest names have a huge weight, but all those companies are pretty significant, all in the technology, communications kind of space. Now, the CompQ, the NASDAQ Composite, is all the names in the NASDAQ 100. So it goes beyond those 100 largest names. And if you go down and look at some of the smallest names in the NASDAQ 100, or in the NASDAQ Composite, that is, sorry, I'm butchering the explanation here. If you go to the smallest names in the NASDAQ Composite, there's a bunch of crap in there. And that is an industry term telling you there's some really junky stuff. I mean, there's a legacy issue where companies that couldn't get listed on the New York Stock Exchange because they don't meet the listing requirements would be listed on the NASDAQ. And when the NASDAQ was an up and coming kind of competitor to the New York Stock Exchange, companies would be listed there. And so, to be honest with you, that's part of the reason why breadth based on the NASDAQ Composite Index is not super helpful, because there tends to be a bearish bias to it, a negative bias, because there are all these really kind of small, crappy companies that are never going to make it. They meet the requirements on the NASDAQ, but they're not sustainable. They don't grow to the point that you'd want. They end up kind of failing. And so The breadth on the NASDAQ composite kind of always drifts lower because of that reason. So when we look at breadth, we try to look at breadth on the NASDAQ composite. That's why the bullish percent index is on the NASDAQ 100 and not the NASDAQ composite, because that always looks kind of artificially bearish because of that. In practice, if you look at the QQQ or the NASDAQ composite, you're going to get very similar data points. I would argue very similar analysis of trends and signals because they're all weighted toward those big names. But that's why there are two different indexes. And the NASDAQ composite is kind of like looking at the New York Composite Index, NYX. That's not true. What's it? I'm completely blanking on the ticker. I should know this. I don't remember. I'm trying to think of what the ticker is. Why am I blanking on that? All right. Well, it happens to all of us, folks. I forget that. I thought it was $NYA. I was pretty sure of that. It is. Okay, I knew it. I thought I had it. So $NYA is kind of like the New York Stock Exchange Composite. It's kind of like the NASDAQ Composite Index. And then like the S&P 500 is a subset. Generally, I mean, it does include some NASDAQ names, but it's like looking at a smaller group of leading names. Kind of think of it in that relationship, and I think you'll be on the right side of things. All right, that was a long-winded and somewhat butchered question, but what else can I answer for you? Marnie, thanks for watching on YouTube. You said, do you infer any correlation between relative strength RS and the market carpet? That's an interesting question. That's a thinker. I mean, yeah, right. So here's the thing, right? On the market carpet, I just kind of default looking at performance. You actually can look at a number of other things which help you more understand. So if you look at like RSI, that, again, that's the RSI. That's a measure of momentum. But if you look at what stocks are stronger versus weaker, it's going to give you a sense of where things are at. So if you do this and say latest value, so this is basically looking at all the members of the S&P 500 and just looking at their RSI values, right? Their measure of momentum. So things that are more green have been demonstrating stronger momentum based on the 14-day RSI. Things that are lower have had a weaker momentum based on the RSI. You can do the same thing like with the scooter rankings. And I would say just make sure you look at latest value instead of one of the changes. If you look at the scooter rankings, this is a stock charts technical ranking. It's a proprietary momentum model based on a couple different time frames. Brighter green means it's in the upper deciles of the ranking or upper percentiles. A brighter red would be in the weaker percentiles. You can see the scale down here. It goes from 0 to 100. So you can see the sectors that are, weaker relative to others, right? Because there's a lot more red than green. You can see the sectors that are generally stronger because there's more green than red. So you can use heat maps like this to think about relative strength and relative performance. I would probably just look at different metrics like that. Another thing I like to do, by the way, is look at like a 1 month change and go to performance. So this is looking at the 1 month percentage change in these different sectors. You can look at year-to-date percentage changes. You can look at sort of different different timeframes to sort of think about what's moving relative to one another over a period of time, what stocks are stronger or weaker. So I think absolutely, does this help you understand the relative strength? Yeah, because when you're looking at one individual point, you're thinking about what that means relative to everything else. So the fact that GE Aerospace is up 49% year to date, that's pretty good. But if the S&P is up 100% year to date, that's not that impressive anymore. So seeing how rare it is for names to be up as much as GE Aerospace or Netflix or Philip Morris, which is up 50% year to date, by the way, helps you understand what that means relative to other names on the heat map. So I think that's actually a brilliant way of using a visualization like this. Great questions right there, by the way. We didn't get to all of them, but we're going to put the rest of them in the Chart This mailbag. We'll do an all mailbag episode on Friday. We'd love to take some more of your questions. So before you go, if there's a question that's on the top of your mind, drop it in the comments section on whatever platform you're at. If you're watching the replay on our YouTube channel, just drop a comment below there as well. Don't forget to watch my latest podcast interview with Jessica Inskip. Also last week's with Tom Boley and Chris Verone. Some really fun conversations with some knowledgeable market practitioners. I hope you find that they nudge your own thinking and improve your market awareness. That's it for today. I'm Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts. Take care, folks.